Hello, everybody. I'm Alex Felicetti. I'm a Realtor sales associate with Pollock Properties Group of Livian here in New Jersey. And I am joined today by the incomparable Matt Keane, Senior
Thank you.
Vice President of Lending at Guaranteed Rate Mortgage. And Matt and I wanted to get together today and just have a quick question and answer conversation that might be helpful to you as you're looking to buy your first home or break into the housing market, because we know that the market of the moment is just constantly changing. And don't worry, we're here to walk you through that and help you by coming from education, right, Matt?
Yes, absolutely. I can fill you in on as much as I can without overwhelming you.
Beautiful. Thank you for being here, Matt.
Yeah,
So,
thanks.
Matt, question. Let's start this off just with a bang. We have a lot of buyers out there. Some are first-time buyers. Some are, current renters, maybe coming from the city or Jersey City or other places like that. And frankly, getting started is so much more than just looking at houses on Zillow. It's really easy to find something you like. But what I would love for you to talk about today is the first step to really being able to look for a home and know what to look for by the time they get to work with an agent like myself or anybody on my team. What is the first process they really need to go through with you in order to move forward with their search?
Okay, yeah, great question. So the pre-approval is the first step. Oftentimes when you work with any realtor or anybody out there for that matter, they're going to ask you for, have you been pre-approved? Have you spoken to a lender? So, I've been doing this for 27 years and I've been always in residential lending, working with the consumer from a retail standpoint, consumer direct. I find the best thing to do is just to have a conversation. I'll have a 20-minute conversation with the buyer where we're going to cover three things: the income, the credit, and the down payment capability. So I'll get some high-level information about base salary versus bonus, how long you've been at the employer, if you're using commission, if they're W-2 or if they're self-employed, maybe a 1099. They're all going to take, depending on those answers, they'll take us down different roads of how we calculate the income. The other thing I'll look at is the credit, right? Whether or not you're over 800, over 780, over 760. They recently made some changes to how they, the rate you'll qualify for based on how high your credit score is. In the past, it used to be one size fits all above 740. Now it's not so much. Now it's 740 to 759, 760 to 779, 780 and over. So that's something to consider. And then the other piece is the down payment. A lot of people don't realize that in our market area, like Morris, Essex, Union County, Northern New Jersey, you can buy a house for up to about 1.125 with as little as 5% down. So that's roughly what, $55,000, a little over that. Yeah. So there's definitely some options. You don't have to let, oftentimes people are like, oh, I got to keep saving, and you keep missing out on the market. That doesn't have to be. So what I'll do is I'll try and have a 20-minute conversation on those details where it's very back and forth, a good conversation where the client's taking away as many notes as I'm taking away from the conversation. And then I'll direct you to the online site where you just basically enter in that information. And it's a very user-friendly 10-minute, 12-minute exercise where you enter in that information. And that gives me the blueprint to issue the pre-approval. And then I follow back up with the client.
That's amazing. So when you go through that process as a buyer and you're pre-approved, yay, you're pre-approved, you get your letter from Guaranteed Rate. How do you then, what's the next step of determining affordability? How do you know once you're pre-approved for $1 million, maybe you don't want to spend $1 million on a house. Maybe you want to be really mindful of what that is costing you monthly, your monthly nut, as we say, right? Can you talk a little bit about how buyers can get such wonderful, crystal clear on what that looks like for them and how they know they are at their comfort zone with their monthly affordability?
Yeah, definitely. So one of the first things I do in the follow-up conversation is exactly what you pointed to, is that you'll oftentimes qualify for way more money than you want to borrow. That's just the reality of it is. And I'll explain the numbers to you in a minute, but somebody might qualify for a mortgage payment that's north of $6,000 a month, but they might be paying rent of $3,500 a month and want to keep their mortgage payment in and around $4,000, right? So oftentimes I say, have you had a discussion with your spouse, or if you're buying the house with somebody else, Have, maybe go through the exercise, have a cup of coffee or a glass of wine, both write down the number on a napkin of where you think you want your max mortgage payment to be and flip it over. You'd be shocked at how often people are sometimes a little bit farther apart than they thought. Like
Right.
somebody thinks that they can go to $4,000 a month. Somebody thinks, oh, I think we should stick to $3,200 a month. Some people want to go to $5,000 a month. So I'd say start there just by having a conversation, looking at your budget, looking at your daycare expenses, looking at your commuting costs, and just gain agreement with you and your spouse as to, hey, what number do we want to be at? And then from there, I guide you into how to really zero in on the target that's going to be the right price point for the house based on the down payment capability. And then the other big factor is based on the property taxes.
Right.
So what you asked for, Alex, was affordability.
Yeah.
I'll give you old school banking guidelines, like way back when with savings and loans. The old school banking guidelines that you heard of was 28 and 36. 28% of your monthly income should be allocated towards housing, and 36% should be allocated towards, to go from difference, that extra, what is that, 8% from 28 to 36 should be allocated for your car payment, your anything else that would show up on credit. So let's just run through a quick example. Say a husband and wife make $200,000 a year household income. That's $16,666 a month. All I'm doing is taking the 200,000, dividing it by 12. That's 1666. You take that for a housing payment times 28%, which seems realistic. Like, hey, I'm going to allocate 28% of my monthly housing expense towards, or my monthly income towards housing. So I go 16,666 times 28%. That's going to give me a payment of 4,666. So in a world that was back like 40 years ago, nowadays that number easily goes to 40%, and then maybe even up to 50% on the back end. So that's why I say that people are going to qualify for more house than they're comfortable borrowing. But I think where this is useful for a first-time home buyer is that when you're buying a house, you really don't know whether or not, say you come to me and say, hey, $4,500 a month is where we want our payment to be. They may or may not know that that's the norm. Maybe they were wondering, hey, am I being too conservative? Am I being too aggressive on that mortgage payment? So if you have an understanding as to how the banking industry and how the lending world looks at your, what they call your debt ratio and your income. So let's just say that we take 30% of somebody who's making $16,000 a month. 30% of that is $4,800. And that's probably a realistic number to allocate towards your housing with principal, interest, taxes, and insurance.
Mm-hmm.
Knowing that Uncle Sam takes a big chunk of that number, just for taxes. And then what's left, we go off of the gross figure. And I'm saying 30% could be allocated towards housing, even a little bit more than that, 35% maybe. And the other thing I'll leave you with affordability is that the mortgage that you're looking at today is based on a 30-year fixed term normally, where meaning the payment's going to stay constant for the most part, other than maybe tax increases. But you'd like to think if you're buying your first home, your income's going to continue to grow. So it's definitely okay to push the envelope a little bit and be uncomfortable, knowing that, hey, this time next year, my salary's going up X. And now that $500 swing that I thought was going to be make or break my budget, that's only $6,000 for the course of the year, and I plan on making an extra $20,000 next year. So now all of a sudden, if I could just get through this year with buying the house, now what I thought was uncomfortable is actually comfortable. So it's helpful like that.
You set us up perfectly, Matt, for something I tell my clients a lot is buy the house and rent the rate.
Yeah.
Buy the house. Right now, there's a nationwide shortage of inventory, just period, the end. And in our area in particular. So you've got 100 buyers and you've got 10 houses, and it's just a scramble from week to week. And all the emotions that come with that, as folks who are looking to purchase a home, who try to make a competitive offer, who might get sort of frustrated, quite honestly, discouraged, if you will, just based on the competition that might sort of decide to step back a minute and say, you know what, we're seeing that rates might be getting a little bit high. But I always say, take the shot, right? If you love that house, if you would be so happy for me to call you and say, you guys, you got the house, then go for it. So can you talk a little bit about that? Buying the house, right? And
Yeah.
renting the rate for now.
Yeah, for sure. So refinancing is a big activity, right? When the rates were below 3%, the entire world was refinancing their existing mortgages.
Yeah.
To refinance a mortgage, it's not that big of a deal. It really isn't. It costs you maybe $500-$600 out of your pocket up front. Any of the actual closing costs, which is different than when you're buying a home and you have to bring all this money to the closing table. When you refinance, you don't have to do that. So say you take a $500,000 mortgage now, and maybe the rates go from 6.5% down to 5% this time next year, you can absolutely just call me back up and say, hey, Matt, where our rates are at. We'd like to refinance. We see all over the news that rates are a lot lower. How much is that going to save us? Maybe it's saving you $300-$400 a month. And the typical cost for a $500,000 loan to refinance is probably $3,500, right? And they put it into the loan amount.
Yeah.
So it just allows the consumer to do the math. If I'm saving $300 a month over the course of 1 year, that's $3,600. It costs me $3,500 to refinance. So I'm basically ahead of the game after month 12 of refinancing. So if you plan on staying in the house longer and long term, that's why everybody always rushes to refinance. So the whole idea when you're looking at terms, especially in an interest rate environment like we're in right now, where the Fed has aggressively raised rates by design, you got to remember that they haven't gone up gradually over time. They've shot up over a short amount of time, which usually means once we get on top of this with inflation, things will start to subside. So there's definitely now more than ever the opportunity to look at buying the house and renting the rate, because you're really just going to refinance the terms when rates come back down. Or the other thing is that a lot of people are looking at adjustable rate mortgages now. They weren't very popular years ago because rates were so low. Why would you take an adjustable? But now that rates are dramatically higher and you can get a rate maybe at 5.5% on an adjustable, well, now maybe it makes more sense to look at the adjustable products, because you can refinance on the adjustable rate just as much as a fixed rate. You can refinance that loan at any given time. So maybe you start off on an adjustable at 5.5%, and when rates do come back down and you see a 30-year fixed or a 25-year fixed, you can just refinance back into the fixed product. And you don't have to restart the amortization table all the way over back on a 30-year. You can go to a 25-year or 20-year. So there's different ways to structure when you refinance back into a fixed rate product.
So I have a question that I think maybe some of our folks who are watching this are thinking, and that is, do you have to wait a particular amount of time before you can qualify to refinance your loan?
No, in the state of New Jersey, there's no prepayment penalty. Ideally, you typically want to make at least 6 payments, right? Just to establish some sense of seasoning and history. But very rarely are you going to see people refinance in less than 6 months of buying a house. But anytime after 6 payments, you could refinance the loan, but there is no prepayment penalty. So if someone decided to close on a loan on Monday and buy a house, they could open up technically an application on Friday and just refinance that loan if the market shifted that much. Right. So yeah, you can do that.
That's
and
great.
It's easy enough.
Flexibility is there.
Yes, absolutely.
Right. So you also touched on something I want to circle back to, and that is when rates come down. Can you talk a little bit about that? Because what I'm trying to do is really educate my clients to understand, to get in a mindset of, these are the rates right now. This is what's happening. We are probably not going to see any rates with 3%, right? Maybe not even 4%. So can you talk about what are the expectations, I think, just as best as you can say? I know you don't have a crystal ball, but how would you say, oh, when rates come down, what does that mean for you in your mind?
Yeah, okay. So, rates are forecasted to come back down in the latter part of 23 of this year, right? Things that have been happening in the news lately, it's not just a matter of the inflation numbers. Like we're talking today, on Tuesday, and this time last week, no one really was talking about Silicon Valley Bank, right? But then all of a sudden, come Thursday or Friday of last week, it came frontline news, right? Front page news. So things happen in the market that you can't foresee happening that will drive the market and drive interest rates and impact the market and lending in a certain direction. So the thought right now is that even if you're borrowing money at 6%, 6.25%, 6.5%, they're going to be trending lower as the inflation numbers start to ease. And that makes a big difference. Here's the other thing too, from a buyer perspective. I wouldn't hesitate jumping into this market, regardless of how competitive it is. And the reason being is that if rates drop by 1%, the statistic is that another million buyers become more motivated to get into the market.
Yeah,
so now
they become active buyers again.
Well, that's what I'm saying. So if you think it's competitive now, what are you going to do if rates drop down to 5% and now it becomes like even more competitive and we're still dealing with the same inventory issues?
Right.
So that's why more important than ever, jump in now, figure out what market you want to be in terms of where you want to live, rip the Band-Aid off, start putting offers in and see what you negotiate, knowing that, yeah, I know the rates aren't the greatest, but that they're trending in the right direction, but at least you'll be in your home when you go to refinance. You won't be having to compete with all these other people that are going to come into the market when the rates do dip lower.
That's right. Or after having paid someone else's mortgage by paying your rent for a year, you might as well be paying your own mortgage rather than.
Yeah, well, you bring up a great point because let's be honest, for as much as rates are higher, rents keep going up. Landlord, I mean, it's been all over the news how landlords over the past 24 months have looked at what they're charging and seeing what they can get for fair market value rent. And the rents have just been skyrocketing. So, which is what's driving people to still be in this purchase money market because they're like, hey, if I'm paying $4,000 a month in rent and now I'm going to have to go to $4,250, well, $4,250 can get you a lot of house. And then you're getting the tax deductibility of the house with the interest and the property taxes. So it ends up being a win-win for the client, for sure.
Definitely. You mentioned something I would love to go back to, Matt, actually, and that is when you're putting an offer on a house. So offers are not, they're a package deal, right? It's not always the highest offer with the highest offer price in that bid. It is maybe the terms of the second best, third best offer price are better and stronger for a seller's peace of mind, right? And I'm seeing that a lot. And I would love for you to talk about it as far as this client pool of buyers, this group of people. How can they make their terms competitive? How can they stand out from a pack?
Yeah. All right. So that's a great point. So in my industry, there's two different frames of reference. One is, hey, what's your interest rate? And you hang up the phone, you keep going. The other thing is when you're doing a pre-approval, I'm going to issue the initial pre-approval. We're always going to update that pre-approval every time you go to make an offer. So it's going to match the property address, the down payment, and the offer that you want to make. But we're going to take it one step further. I'm going to suggest to the borrower at no cost to them that we put the file through underwriting in what they call our power bid program. It allows the income and the credit and the assets to be signed off on. And now it's only subject to finding a home. So what that does to the buyer is, say you're going up against a cash offer, you can offer a 21-day closing knowing that you've already been issued a mortgage commitment and it's only subject to really finding the house, having the appraisal done if needed, the title work that's done through your attorney's office, and homeowner's insurance. So you can do that and close in literally 21 days. And why that matters to the seller is that in today's market, when you're getting all these offers, more often than not, 3 of the offers are going to be very close, right? Say you get 10 offers on a house, 7 of them are not going to be in the game. 3 of them are going to be very competitive and very tight with their terms. After they look at the price, they then look, all right, well, this person who's right in there, they don't want to close for another 60 days. This person wants to close in 45 days. Oh, this person wants to close in 28 or 30 days. And I want to move on because I already got relocated for work and I want this off my to-do list, selling my primary house, right? I'm the seller. So I'm going to look at the financing. I'm going to look at its guaranteed rate. I'm going to look at its Keane. I'm going to look at it. There's a relationship there. I'm just saying that people tend to know people in the community that you're working in, right? And if they see your name on pre-approvals constantly, and that there's no hiccups, and that the client has a great experience, and they get to the closing table on time, and there's competitive terms, that gives them a sense of mind. In fact, yesterday we had an offer on a house. The listing agent called me. They had 4 offers. The listing agent called me at 9:15, wanted to go through the offer that my buyer agent had made. Julie on your team had this offer. Then at 3 o'clock, the listing agent called me. She's like, listen, we're going to accept the offer, but we're accepting it because you're doing the financing. Because I told them we'll order the appraisal upon verbal acceptance of the offer being accepted, and that we're
Wow.
willing to have the mortgage commitment issued within 5 days of the offer being accepted. So
Yeah.
whenever you can jump through hoops, because remember, why that matters to the seller is that it takes the stress of any possibility of having them to put this house back on the market or somebody falling through on financing issues, which is still very real. It takes all that guesswork right off the table. And
That's
they can
right.
feel comfortable about accepting the offer. So
That's
our
right. They can
power
sleep at
bid,
night.
yeah, and that's why, like, so
Everybody
that
can sleep
power
at night
bid,
when that happens. Hmm.
yeah, for sure. That's why that power bid program has been such a game changer, because instead of getting the pre-approval, you're actually issued a mortgage commitment. And now you can go out as a consumer and really shop with confidence and be like, listen, I know you have a cash offer. This is just as good as cash. We'll do the same closing timeline, no problem.
Right. Yep. Matt, this has been just so informative. I even knew what we were talking about and what we would be talking about today, and I already took a page and a half of notes.
All right.
My colleagues will laugh at me when they see that part. But, I think that the takeaway here is just explore all avenues for you in this moment. If you find the house you love, then jump on it the best you can. And with people like you as a resource and on the team, right? I always call it the team.
Yeah.
We're strength in numbers, right? So, you guys, if you're watching this, thank you so much for watching it. I hope that we've answered your questions. I think that was a lot of information. And yet, if you have any other questions, please reach out to Matt Keane. Matt's contact information is on that banner right behind him, 973-295-6478. And rate.com/Matthew Keane. And to contact me, you can do so. My cell phone is 917-696-0754. And also you can look up pollockpropertiesgroup.com and get connected with myself and any of my colleagues on our team, because we are here for you, as my sweatshirt says.
Care, serve,
Care,
give.
serve, and give. So anyway, have a great day. Go find a house. Thank
There you
you.
go. Thanks, everybody. Thanks,
Bye.
Alex.